Traders, welcome to True Trader FX University's educational series, The Secret to Passing Prop Firm Challenges. If you've been struggling to pass a prop firm challenge, you're not alone. Most traders face setbacks because these challenges are designed to be tough, but that doesn't mean you can't win. In this video, I'm going to break down exactly how prop firms work, why so many traders struggle, and most importantly, how you can pass your challenge with a simple 3-trade strategy. No overtrading, no blowing your account, just a clear, structured plan to help you hit your targets and stay consistent. Make sure you subscribe to the channel, turn on notifications, and follow us on social media for more tips and strategies. Now let's get into it. All right, here's what we're covering today. First, we'll break down what a prop firm is and how they operate. Then I'll explain why most traders struggle to pass these challenges and how prop firms are set up to profit from that. Next, I'll walk you through a simple 3-trade strategy that's designed to help you hit your profit targets without overtrading. Finally, I'll share the best prop firms and account sizes to use so you're setting yourself up for success from the start. By the end of this video, you'll have a clear step-by-step strategy to improve your chances of passing any prop firm challenge. So stick around, you don't want to miss this. Okay, let's dive in. Well, what's a prop firm? Prop firms have actually been around for a long time, but now that retail trading is blowing up, the prop firm industry is growing fast. And yeah, some of these firms are legit, but not all of them. There are definitely some red flags to watch out for, and we'll get into that later. So instead of trading your own money, you get to trade with the firm's capital. First, you pay an evaluation fee to enter a challenge. If you pass, you get a funded account, and most firms will refund your fee once you pass. After that, you keep most of the profits, usually between 70% and 90%, while the firm takes a small cut. It's a way to trade bigger without putting your own money on the line, but you've got to prove that you can trade with risk management. All right, and let's talk about the truth behind prop firms. Prop firms don't expect you to win. They're betting on you to fail. That's how they make money. They're not making money from your trading. It's the fees you pay to join the challenge. Most traders blow their accounts in the first few days. And if you fail, chances are you'll try again, which means more fees for them. And here's the kicker. You're not even trading real money. That funded account is basically monopoly money, just a demo account tied to their risk system. When you make a profit, the firm isn't paying you from the market. They're paying you from fail challenge fees collected from other traders. That's how they can give you 100K to trade, because you're not actually accessing real market liquidity. Now, let us talk about why traders use prop firms, because there is a reason so many people are turning to them. When you trade with a prop firm, you are basically getting access to way more capital than you would have on your own. That is the big draw. Let us say you have a $100,000 prop account. A 5% move could make you $5,000. But with a $1,000 personal account, that same trade would only get you $50. Big difference, right? Here is how it works. You pay a fee to take a $100,000 evaluation. If you meet the profit target of 10%, that is $10,000 in profits. With a 70% payout, you would keep $7,000 and the firm would keep $3,000 as their share. But there are rules. Prop firms have daily and total drawdown limits, which means you cannot lose more than a set percentage per day or overall. Some firms may also have additional terms in the fine print, so it is important to review the details carefully before getting started. Prop firms like to hide rules. Now, let's continue. All right, so here's where things get tricky. Let's talk about why winning traders are actually a problem for prop firms. If too many traders start winning consistently, the whole business model starts to fall apart. Think about it. The firm would have to pay out large sums from the fee pool. Their liquidity and operational costs would go up, and managing their risk model would get a lot harder. That's why prop firms put rules in place to protect themselves. Daily drawdown limits. If you lose too much in a day, you're out. Total drawdown limits. If you hit a certain percentage loss overall, you lose the account. Then there's payout delays. Most prop firms struggle to pay big withdrawals, and if too many traders start winning, they'll tighten the rules to make it harder to pass. Let's break it down. If a firm has 1,000 traders paying $500 each for a 100K challenge, that's 500K in fees. Now, if 10% of those traders pass, that's 100 traders qualifying for a funded account. If each of them hits a 10% profit target, that's 10K per trader. With a 70% payout, each trader would keep 7K, meaning the firm would owe 700K. So the firm collects 500K but owes 700K. That's a 200K loss. If more traders start passing, those losses multiply fast. That's why firms set strict rules, drawdown limits, payout delays, and sudden rule changes to protect themselves from paying out too much. So how do you increase your chances of success? Let's get into that next. So now that you know why prop firms make it hard for traders to win, let's talk about how you can still come out on top. Look, the game is rigged, but that doesn't mean you can't win. Prop firms expect you to overtrade and blow your account. Now, that's how they make their money. But once you understand that the capital isn't real and the system is designed to make you lose, you can approach it differently. The key is to stay disciplined and follow a structured plan. You can't get caught up in the emotions of the trade. That's what they want. Prop firms are designed to make you lose. But when you understand how the game works, you can flip the script. Now, let's talk about how to build that winning strategy. So now that you know the game is rigged, let's talk about how you can actually pass a prop firm challenge, because it's not about luck, it's about strategy. Passing a prop firm challenge isn't about taking every trade you see, it's about being selective and strategic. You don't need to hit 50 trades to pass, you only need 3 good trades, that's it. And honestly, it was easy following this simple strategy. We've already passed phase 1 and phase 2 with FTMO, and we've made withdrawals. It works. The key is staying disciplined, waiting for the right setups, and sticking to the plan. When you keep it simple, it's way easier than you think. It's not about overtrading, it's about working smarter, not harder. We've done it, and that means you can too. So now that you know it's possible, let's break down the actual strategy that works. Before we get into the strategy, there are some key terms you need to understand. These 4 terms are crucial if you want to successfully pass your challenges. So let's break them down before we dive into the strategy. First up is risk-reward ratio. This is the ratio of how much you're risking versus how much you aim to gain. A 1-3 risk-reward means if you risk $100, you're targeting a $300 profit. For example, if you risk $1,000 on a trade with a 1.3 risk-reward ratio, you'd be aiming for a $3,000 profit. Understanding this helps you stay disciplined and avoid overtrading. Next is max exposure. This is the total percentage of your account that's at risk at any given time. Think of it like juggling. The more balls you have in the air, the harder it is to keep control. If you risk 1.25% per trade and you have 3 trades open at once, your max exposure would be 3.75%. For example, on a 100K account, that would mean 3,750 at risk. Now here's where greed becomes a problem. When you get confident after a win, you might start stacking trades thinking you've got it figured out. But that's exactly how you blow your account. Opening too many trades increases your exposure, and if the market turns, you could hit your drawdown limit fast. That's why managing exposure is so important. It's about staying controlled and not letting greed push you over the edge. Now let's talk about daily drawdown. This is the maximum percentage of your account you're allowed to lose in a single day before the account is shut down. Most firms set this limit at 5%. So if you have a 100K account, you can't lose more than $5,000 in one day. But here's the catch. If you hit that limit, you lose the account and you don't get a refund. So it doesn't matter if you were close to your profit target or on a winning streak. Once you cross that line, the account is gone. That's why managing risk per trade is so important. If you go in too heavy on one trade or try to chase losses, you could blow the account in a single move. It's not about how much you win, it's about staying within that daily limit. Finally, there's overall drawdown. This is the total amount you can lose over the lifetime of the account before you lose your funding. Most firms have a 10% overall drawdown limit. So with a 100K account, you can't lose more than $10,000 overall. If you hit that limit, the account is revoked. No second chances, no refunds. It doesn't matter how long it took you to reach that point or how close you were to your target. Once you cross that line, the account is gone. That's why tracking your total risk over time matters just as much as managing daily losses. You can't afford to dig yourself into a hole, because even if you have a big win later, it might not be enough to recover. All right, now that you've got the key terms down, let's dive into the strategy that helped us pass. All right, now that you know the key terms, let's go over a structured approach that works when applied correctly. The 3-trade strategy is based on focusing on high quality setups with a strong risk to reward ratio. Most firms require an 8% to 10% profit target, but you don't need a large number of trades to reach that goal. If you plan 3 trades with a 1.3 risk to reward ratio and manage them well, you can reach your target efficiently. For example, risking $1,000 on a 1.3 setup means a potential $3,000 return. 3 well-executed trades at that ratio could total $9,000, enough to meet a 100k account target with room to spare. The key is precision and discipline, not overtrading. What makes this strategy so effective is that it forces you to focus on high-quality setups, so you avoid overtrading. The risk is controlled and small enough that you can survive losses without hitting your drawdown limit. And because the reward is high, you maximize profit while keeping your exposure low. Now that you understand the strategy, let's dive into the 3 key things you need to do to pass. This is where it all comes together. Now, this isn't the only strategy you can use to pass a prop firm challenge, but this is the one we highly recommend. We've seen a 100% success rate with this strategy among both beginners and experienced traders in our community. When followed correctly, it's simple, effective, and keeps you within the firm's guidelines. Let's get into the first part. The first key to this strategy is trading monthly levels. Monthly levels are major price points where the market tends to react because they reflect institutional activity and long-term trends. Here's why this matters. Monthly levels are stronger and more reliable than daily or weekly levels. When you focus on monthly levels, you're essentially trading where the big money is moving, which gives you higher quality setups. But you need a solid technical strategy to spot these levels correctly. That means understanding support and resistance zones, trend lines, and market structure. It's not enough to guess, you have to know what you're looking for. If you're not confident in identifying these levels or building a technical strategy, we've got you covered. You can join our mentorship program or become a member of our VIP trading floor, where we walk you through how to spot these levels and align them with the overall trend. All right, now that you know why monthly levels are key, let's move on to the second part, targeting the right risk to reward ratio. The second part of this strategy is all about risk to reward, and this is where a lot of traders mess up. For every 1% you risk, you should aim for a 3% profit. That's a 1.3 risk to reward ratio. Why is this so important? Because it allows you to stay profitable even if you lose more trades than you win. Let's break it down. And if you risk $1,000 on a 1.3 setup, your potential return is $3,000. If you win just 3 trades at that ratio, you'd make $9,000, which is enough to pass most prop firm challenges that require an 8% to 10% target. This strategy works because you don't need a high win rate to succeed. If your wins are 3 times bigger than your losses, you can still come out ahead even if you lose more trades than you win. That's why aiming for a 1.3 ratio is so important. It keeps you profitable even through the losing streaks. Now that you know how to structure your risk to reward ratio, let's talk about the final piece, managing your risk. The last and most important part of this strategy is managing your risk. This is where most traders blow their account, and it's completely avoidable. Here's the rule. You should never risk more than 1.25% of your account on a single trade. Keeping your risk low gives you room to survive losing streaks without hitting the firm's drawdown limits. Here's how you manage it. Risk no more than 1.25% per trade. Keep a maximum of 3 trades open at once. This keeps your total exposure at 3.75%. If you lose 3 trades in a row at 1.25%, your total drawdown is still within the limits of most prop firms. And this is where it gets serious. If you break this rule, you're going to start trading emotionally. And that's when things go downhill. When you start chasing losses or getting greedy, you'll blow your account faster than you think. That's why you can't afford to ignore this rule. It's what keeps you disciplined and in control. So that's the 3-trade strategy. It's not complicated, but it works when you stick to it. Focus on high quality monthly levels, target a 1.3 risk to reward ratio, and keep your risk controlled at 1.25% per trade. That's how you stay consistent, avoid emotional trading, and put yourself in the best position to succeed. Now that you know the strategy, let's talk about why it works so well. The reason this strategy works is because it's built to keep you disciplined and focused. Let's break it down. Keeps risk low. By risking only 1.25% per trade, you protect yourself from hitting drawdown limits and losing your account. Small controlled risk helps you survive losing streaks. Maximizes reward. A 1:3 risk to reward ratio means you can win only 30% of your trades and still come out profitable. You don't need to win all the time, but you just need the wins to be bigger than the losses. Reduces overtrading. Fewer trades mean less emotional stress and better decision making. You're not chasing every setup, so you're waiting for the high quality ones. Accounts for losses. Even if you lose 2 trades and win 1, you'd still come out profitable because the wins are 3 times larger than the losses. It's not about taking more trades, it's about taking better trades with a clear plan. All right, now that you've got the strategy down, let's talk about the best prop firms out there and how to choose the right one for you. All right, now that you've got the strategy down, let's talk about the top prop firms you can trade with. Now, we're not ranking these in any specific order because honestly, they're all solid options. In our community, we've seen traders get consistent 5-figure payouts from each of these firms, and they've all been around for over 5 years, so they have a track record of reliability. The key here is that you don't have to stick to just one prop firm. You can trade with multiple firms at the same time to increase your overall capital and create more opportunities. Start small, build your confidence, and scale up once you're comfortable. First up is Rebel Funding. Rebel offers a max account size of $320,000 and operates worldwide. Their profit split is between 70 and 90%, which is competitive with other firms. Their target is 8% in phase 1 and 5% in phase 2, with a 5% daily drawdown and a 10% total drawdown limit. What's great about Rebel is that they refund your challenge fee up to 200% on some accounts when you pass, which gives you extra confidence going forward. Next is FTMO, which is one of the most well-known names in the industry. FTMO offers a max account size of $400,000 and operates worldwide except for the United States. Their profit split is also between 70 and 90%, with a 10% target for phase 1 and 5% for phase 2. Like Rebel, they have a 5% daily and 10% total drawdown limit, and they refund your fee when you pass. FTMO has been a favorite for many traders because of their solid reputation and reliable payouts. Oanda is another strong option. They offer one of the largest max account sizes at $500,000. Their profit split is between 70 and 80%, and the target is the same as FTMO, 10% in phase 1 and 5% in phase 2. They follow the same drawdown limits of 5% daily and 10% total. The higher account size makes Oanda appealing for traders looking to scale up quickly, and like the others, they refund your fee when you pass. And the best thing about Oanda is that they offer 500k accounts. Finally, there's City Traders Imperium. CTI offers a maximum account size of $200,000 and operates worldwide. Their profit split is between 70 and 80%, with a 10% target for phase 1 and 5% for phase 2. The drawdown limits are consistent with the others at 5% daily and 10% total. CTI has a solid track record, and they also refund your fee when you pass. What makes CTI unique is that they also offer instant funding accounts, which allow you to skip the challenges and start trading with a funded account right away. These accounts cost more upfront, but they give you the advantage of avoiding the challenge phase and going straight into trading with real capital. The key takeaway here is that you don't have to limit yourself to just one prop firm. Many traders in our community are funded with multiple firms at the same time, which gives them more capital to work with and spreads out their risk. If you pass with 2 or 3 firms, you're essentially multiplying your earning potential. But the key is to start small, get comfortable with one firm, and then scale up once you have a solid strategy in place. Now that you know the best prop firms to work with, let's talk about the best account size to choose from. When it comes to choosing the right prop firm account size, it's all about finding the balance between profit potential and what makes sense for your budget. There's no perfect account size. It really comes down to what works best for you financially and what aligns with your goals. Let's break this down. If you're working with a smaller budget or you're just starting out, a smaller account might be the best option. For example, a $10,000 account typically costs around $150 to access. A 10% gain on that would be $1,000, and depending on the profit split, you could walk away with anywhere from $700 to $900 in profit. Not bad for a small starting point, but if you're more experienced and have the budget to go bigger, larger accounts give you more room to scale up. A $500,000 account costs around $2,500, but a 10% gain would be $50,000. If you're on a 70% split, that's $35,000 in profit, and it scales up even higher if you're on an 80 or 90% split. The key is to look at how much you're investing into the account compared to the potential profit you could earn. This chart shows the numbers clearly. You can pause the video here and take a moment to see which option makes the most sense for your situation. And remember, when you pass the challenge, most prop firms will refund your challenge fee. So even if you start small, you're essentially getting your investment back once you prove you can meet the target. That's why starting small and scaling up is such a smart approach. At the end of the day, the best account size is the one that fits your financial goals and your comfort level. If we've done it, we can help you understand how to do it too. It's about applying a structured and consistent approach to the market. We've completed these challenges and achieved steady results by focusing on a clear strategy and managing risk effectively. Success comes from understanding market conditions and making informed decisions. If you want to learn how to approach the market with confidence, you can join our VIP Discord server, where we explain market setups in real time. For more detailed guidance, our 4-week mentorship will walk you through the process step by step. Now let me show you some of traders in our community who have followed this approach successfully. This is real proof from traders in our community who have passed their challenges and secured payouts. These are real results from traders who followed the strategy and stayed disciplined. They didn't win because they got lucky. They followed a plan, managed their risk, and focused on quality setups. That's what made the difference. If you're ready to follow the same steps, the path is already laid out for you. The strategy works, you just have to commit to it. You've seen the results. Now it's time to take the next step. Now, before we wrap this up, let's talk about why timing matters when it comes to prop firms. Prop firms won't last forever. The prop firm model works because most traders fail. That's how they stay profitable. But as more traders become profitable and start winning consistently, firms will face pressure to adjust. They might start tightening rules, reducing profit splits, increasing fees, or even limiting payouts. If too many traders start winning and firms start losing money, they'll have to adjust to stay afloat. That could mean lowering payout rates, increasing evaluation fees, and adding more restrictive trading rules. If they can't maintain liquidity, the firm could collapse. And once firms stop paying, traders will stop joining, which means even less liquidity in the market. That's why now is the time to act. The current model works well, but it may not stay this way forever. Make sure you like, subscribe, and share this with a friend. If you want to join our free Telegram channel where we share trading signals and helpful tips, click the link in the description. Turn on notifications so you don't miss out on more educational content. Thank you for watching. Leave a comment to let us know if this video helped you or if you have any other questions.